All right, so let's dive into crypto prices. Everyone's heard of Bitcoin going crazy, right? Like up and down and all over the place. But have you ever thought about like what actually causes those price swings?
Yeah.
That's what we're going to unpack today, and you might be surprised by what we find. We're taking a deep dive into a paper by Eibert and Liao. They use some really fancy financial modeling to try to understand crypto prices. So today we're going to break down what drives crypto prices and why you should care. Like, for example, did you know that in 2022, good old-fashioned monetary policy from the Fed actually played a huge role in Bitcoin's drop?
Yeah. You know what's cool about this paper? It doesn't try to predict the future of crypto. It's not about telling you what to buy or when to buy it or anything, but it focuses on understanding the forces impacting prices today, which is really useful for anyone trying to figure out this whole crypto thing.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, so break it down for us. They basically created a model to dissect Bitcoin's daily price changes, right? But they didn't just lump everything together.
Right. They separated it out into 4 categories. They wanted to understand the impact from the outside world, things like interest rates from the Fed, or how risky people think the markets are in general. And then they looked at what's happening inside the crypto market, like how quickly crypto is being adopted, and how risky people think crypto is.
Interesting. So it's not just like crypto hype or fear. There are like actual measurable factors from the traditional financial world that are also impacting crypto prices.
Exactly. And one of the big findings, this is where it gets really interesting. While those daily Bitcoin swings, they seem kind of random, a lot of that is driven by things just within crypto. But over the long term, things like what the Fed does actually have a surprisingly strong impact.
Wait, the Fed, as in like the interest rate people, they can actually mess with Bitcoin.
It sounds weird, but yeah, their research shows that there's a connection. They point to the 2022 Bitcoin crash as a perfect example. Remember that huge drop? Well, their model suggests that without the Fed tightening its monetary policy that year, Bitcoin would have only fallen 14% instead of the 64% that it did.
Well, 14 versus 64, that's a huge difference. You're saying the Fed basically made the crash like 5 times worse?
That's what the model shows, yeah. It really shows how connected traditional finance and crypto can be, especially over these longer periods of time. And to dig even deeper, they brought stablecoins into the mix.
Okay, before we get there, for people who might not know, can you explain what stablecoins are and like why they matter in this whole crypto price puzzle?
Sure. So think of stablecoins as the safe haven inside of crypto. They're usually pegged to something stable, like the US dollar, so their value should stay pretty much the same, unlike, Bitcoin going up and down all the time. And this let the researchers separate out the effects of people getting excited about crypto in general. We call that adoption. Separate that from people getting scared within the crypto market itself, and that's where the idea of a risk premium comes in.
Okay, so if people are nervous about crypto, they might move their money into stable coins. It's like running for cover, but you're staying inside the crypto world.
Exactly. It gives us a much better view of how things are really working. And to show this, they analyzed a few specific events.
Perfect. Let's hear about those. Where should we start?
Let's go back to the beginning of the pandemic, March 2020 crash. You remember that, right? Both the stock market and the crypto market experienced what are called risk-off shocks.
Oh, yeah. Total chaos. Everyone was panicking. What happened in crypto?
Well, you'd expect people went running to stablecoins. If you look at figure 8 in the paper, you can see stablecoin market cap just shot up.
So even though Bitcoin was falling apart, people were putting more money into stablecoins. Like they were trying to stay safe, but inside the crypto system. That's wild.
It is. Now compare that to the FTX collapse.
Another big crypto event. How was that one different?
Well, unlike the COVID crash, FTX was mostly a crypto thing. Bitcoin obviously tanked. But what's interesting is that stablecoins spiked again as people looked for safety, but again within crypto.
So in both cases, stablecoins were like the safe place to be, even though those events had totally different causes.
Exactly. And this strengthens their argument that to understand crypto prices, you got to look at what's happening both inside and outside the crypto market. Now for our final event, let's jump to something more positive. the launch of the BlackRock Bitcoin ETF.
Okay, that was huge, right? BlackRock is a big deal in traditional finance. Them launching a Bitcoin ETF felt like they were saying, hey, Bitcoin is legit.
Totally. It was a sign that big institutions were getting interested in crypto. And what we see during this period, more people adopting crypto, which makes sense. But even more importantly, we see the crypto-specific risk premium going down.
Hold on, break that down for us. What does it mean that the risk premium went down?
So think about it like this. If people are worried about a cryptocurrency, they're going to want a higher return to make up for that risk. That's the risk premium. But when someone like BlackRock comes in, it tells people, hey, maybe Bitcoin isn't as risky as we thought. And that feeling can spread, so the risk premium goes down.
So if even the big traditional finance guys are starting to see Bitcoin as less risky.
It could mean that Bitcoin becomes more attractive to like a wider range of investors. It's a cool development. And it really shows how these internal and external forces we've been talking about can interact.
It makes you wonder what this all means for like the average investor. Should we all be buying Bitcoin now that the big guys are getting in on it?
Well, I can't give financial advice. And I definitely don't have a crystal ball. But what I can say is that this research gives us a really useful way to think about what actually drives those crypto price swings. It's not just hype, you know. There are real measurable things happening both inside and outside the crypto market.
Sounds like we need to be paying attention to both sides of the story. So just to recap, if you want to understand crypto prices, you got to look beyond just the headlines. Think about what's happening inside crypto itself and what's going on in the rest of the financial world.
Exactly. And remember, this is all constantly changing. On the crypto side, you've got things like how quickly it's being adopted, new technology coming out all the time, and even just the general feeling within the crypto community. All that stuff can impact prices.
And then on the other side,
Mm.
you've got the Fed setting interest rates, how much risk people are willing to take in the market overall, even what's happening in the global economy.
Yep.
It's like a complicated dance with a lot of different partners, all moving in different directions. Which brings us to a good question. This paper focused on Bitcoin, the biggest name in crypto. But do you think these same forces are at work with other cryptocurrencies too?
That's a great question. I mean, there are thousands of cryptocurrencies out there, and they're not all the same.
Right. It's very possible that those big forces we talked about, monetary policy, risk appetite adoption rates, they're probably affecting other cryptos too.
Yeah.
But each one likely has its own set of internal things driving it, whether it's the technology behind it, the community supporting it, or even what it's supposed to be used for.
So like the big picture might be similar, but the details could be totally different depending on which crypto we're talking about.
Exactly. There's no one answer for all of crypto.
Which is probably why people find it so exciting and scary at the same time. It's dynamic. It's always changing. That's why it's so important to do your research and understand what you're putting your money into. Don't just follow the hype. Dig a little deeper. Think about all these different forces we've been talking about.
Couldn't agree more. Informed investors make better decisions, especially in a market like this.
And all of this knowledge can help us make smarter decisions in this exciting but often unpredictable asset class.
Well said. So to wrap things up for our listeners today, we've learned that crypto prices aren't just random. They're driven by this fascinating mix of factors, both from within the crypto market itself and the broader financial landscape.
Yeah, and we've seen how stablecoins can provide a kind of safe haven within crypto during those turbulent times, and how the entry of major players like BlackRock can signal a shift in risk perception.
Exactly. And all of this gives us a better understanding of the forces shaping this exciting and ever-evolving world of crypto.
It's a journey that's full of twists and turns, but with a little bit of insight, we can all navigate it a little bit better.
Couldn't have said it better myself. So until next time, folks, stay curious, keep learning, and keep exploring the fascinating world of crypto